Well, let's make it super official. Jerome Powell is a jackass. He spoke today at Harvard, and I'm not happy about some of the comments coming out of there. And I don't know if he's intentionally tone deaf to some of the shit that he says, or if it's just him being him in moments. And I don't know if he maybe he's politicizing it. Maybe he wanted to give kids hope. I don't know. But we're going to go over some of the clips that came out of that Harvard discussion this morning. And I'm going to tell you right now, I am seething at the disconnect to reality that you're giving kids, right? And first of all, if you're a kid, why are you looking to Jerome Powell for advice on the age of AI? I mean, just right out the gate, I'm pretty sure that guy ain't the guy. You know what I mean? But whatever. Okay, fine. And then he's talking about, oh, rates can go either way. It can go either way. It really depends on what's going on. No, it can't, dude. The market's spoken here. We got models we're going to go over today on the show to help show you that Jerome Powell, amongst other things, is completely full of shit. But before I go any further, welcome to the Higher Standard Live. I'm your host, Chris. There is a second host, Saeed Omar, who will be popping in momentarily in the chat. You will see him facilitating the dialogue and discussion there. Cam Pop made it. Yeah, what up, Sean? There you go. Got Rosie. We got some other people there in the chat. I can't see all the names. I probably should put my glasses on, but I'm not gonna do it. This show is lovingly brought to you by the team over at Fridays. Go to joinfridays.com. Use code HIGHER. Get $100 off your first order. Everything from GLP-1s, NAD+, plus some peptides. Get right, feel right. They're going to help you do it. So the models that we use on this show go into feeding something that we're building called Alpha. Alpha is, as the name suggests, a product which is going to help give you a competitive edge in the markets. Now, this is not investment advice. This is not us telling you to invest. What it is us giving you the same optics into things that we see. The show is designed to bring you the full day of CNBC within approximately 45 minutes to an hour, strategically timed at a point about an hour before the market closes, so you've got insight before the market closes and the headlines come out for the day. We have seen a bit of a green day. The market is coming back. We'll cover the market here. We'll go over the market status, go into our liquidity, synthetic volatility index. We're going to go into home affordability, the sectors. We're going to look at the calendar. We're going to talk about the forecast. And then we're going to get into my favorite part of the show, the XAI, where we pull in the behavioral economics, the rhetoric from social media, and we talk about what you guys are talking about out there in the real world to perpetuate the feedback loop that we now know drives the headlines, right? What happens in social media makes mainstream media makes the trading headlines, and so on and so forth throughout the rest of the day. Today was an interesting day because Jerome Powell was scheduled to speak at Harvard. He did so, made some stupid ass comments. Those comments are making the rounds. So, of course, it goes without question that we're going to have to really kind of dive down into what all that bullshit was about. And let me actually kill one program in the background here, which is probably going to cause some drag later on. There we go. All right, good. So, with no further ado, I think we should jump right in to the market status. We are still in a capital fleeting position. Dow Industrials are down incrementally. S&P, NASDAQ, Russell, InvestQ, QQ, all down incrementally in the day, but we are still not fully recovered. We were down as far as a risk-off position, but definitely not a full liquidation. And if you're new to the show, this Chiron and this heat map down at the bottom of this chart will be your navigation as we go through the sectors later on. This gives you the broad markets using ETF as proxies for the indices because we like the real algorithmic derivative trading showing up. It tells us more about what's really going on. And part of the reason why is the internet is over 50% now bots and non-human activities. So if that's the case, we have to acknowledge what these non-human actors are doing. So looking at the indices as a purity play is a bit naive to how the market is actually working these days. So we're seeing a capital fleeting risk-off position. That's because you're not seeing any improvement over the weekend. The geopolitical unrest, which is driving oil prices and further sabotaging the economy. There is an aspect here that it remains to be seen about jobs, which we've seen manifest and continue to manifest in the disruption caused by AI. Part of the reason I'm so pissed off at Uncle Jerome. If you are new here, please comment. You are welcome to do so. We stream on a multitude of platforms. Some days are bigger than other days on other platforms, but YouTube, LinkedIn, X, they all feed into the comment section, and I can and will share your comments in real time. And there's also other platforms which don't feed in, like Instagram, for example. If you're watching on vertical format, some of this is harder to see. I recognize that. Switch over to a horizontal format show. You might find it a little more aesthetically pleasing. Synthetic volatility index. This is our proxy for the VIX. We try to use a more real world pragmatic view. And when we started off earlier in the year, this was around the high 80s. We're now down to 55. And the reason why we use a proprietary model as opposed to using the VIX is we're trying to use this as our backstop for when it is a good or bad time to invest using our models and our prediction algorithms. So because of that, we take a little bit of a different tack than what I would say the normalized VIX is. But as all things on the show, it's just as much about education. It is about sharing. I show you exactly how I get this information. You can go straight over to CNBC yourself at any point in time. Type in here, go down to VIX, VIX. There you go. Anything above 20 in our mind is historically a heightened fear market. They do call this the fear gauge for a reason. We are sitting at a nice 30.79. Not a whole lot of improvement over the weekend. There has been no material headlines to change the narrative there. For those of you watching on the Instagrams, I appreciate you. This is going to be a pretty interesting time where we've seen a pivotal statement made by the White House, which I think could impact the markets. The White House is suggesting that they're in talks to resolve this matter, led by the conversation with the Pakistani government. But it seems as if Iran is rebuking those statements, saying that it's market manipulation in the headlines, and who knows what you should believe because there's a lot of information and disinformation out there. So we can go to CNBC the same way you can, but I do tend to prefer our own proprietary models. This is our synthetic volatility index. Kind of gives me an idea of intraday stress, looking at cross market, looking at several different indices where we're at. Cross market volatility is still the only thing that is healthy. The markets are seeming to react in unison with one another for a large part, and that is what that really is made up of. So when you go over here to the market status, you can kind of see that we're still in a capital fleeting position, but we're all relatively even on the day. So doesn't matter what sector you're in, doesn't matter what space you're in, and we're going to explore that. As we go through the sectors, keep your eye on this bar down here. It will be the exact same thing, and it'll tell you the position of everything relative to the market. That's going to be kind of your North Star. We use this with the sector analysis to give you an idea of how each individual sector is performing. This is a real-time analysis, so if the market does pivot while we're talking, expect to see that. And that does happen on our show from time to time because this is closing in the last hour towards the top of the show whenever the markets have their last kind of movement and momentum in the day. So you might see a little bit of that rally. It would not surprise me if we got back to a mixed day or we stayed right here. So that is what it is. Let's look at the market liquidity. The liquidity position of the Federal Reserve. This pulls directly from the St. Louis Fed's API, gives you a look at the Fed's balance sheet, which is flooding the market with cash. But when you net out the bank reserves, treasury account, you get a net liquidity level of drain. This number has actually increased, so we're actually pulling a little more, incrementally more liquidity out of the system than we had been historically. The whole non-QE, QE thing that the Fed was talking about 2 meetings ago is now materializing a little bit, in that you're seeing a little bit more liquidity go towards the banks because they're looking to, quote, have liquidity on hand for people who are paying taxes at this particular time. Let's look at the home affordability. Home affordability continues to be stretched. This has only gotten worse. Should come as no surprise. The only surprise to most people is that supply is not the biggest limiting factor in this. It's income momentum, i.e. wage growth. It's price to income ratio. Home prices are too high relative to income. Again, wage growth solves that problem. Mortgage rate pressure has gotten worse. It should come, again, as no surprise to a lot of you that mortgage rates have not gotten better. As a matter of fact, we often talk about on the show that the 10-year is the best proxy for where the 30-year market is going to be. So going over to the bond market, what I do is anytime, and you guys can do the same thing, go over here to CNBC, click bonds, click here. You got some small improvement in the treasuries. This is actually a big improvement in mortgage rates, but typically speaking, historically, you saw about 2% over the corresponding treasury to give you about the 30-year, kind of a price range. So you'd be at 6.5-ish, maybe 6.25, somewhere between that spectrum today. But you've seen some mortgage rate compression and margin compression in recent months across all product types. So it wouldn't surprise me to see mortgage rate spreads around 180. So that's why I say, 6.25. So I think you're sitting today, if I were to look at the numbers, probably somewhere in the 615 range on average for a 30-year mortgage rate, which again is not bad historically, but relative to everything else, it's not exactly what I would call ideal. Let's do one other thing while we're here at CNBC. Let's go over to the oil market. This was the one that we saw rising over the weekend. There are 2 types of oil you should be aware of. One is WTI crude 103. This is at or near a session high. As a matter of fact, this, if I go to a 5-year look here, it's not near its 5-year high, certainly, but it certainly is the highest it has been in the last year. And it is peaking up, not down. So this does not tell you that the markets are feeling like there's relief coming at any point in time. So the other type is we're going to talk about is Brent crude. Brent crude is down a tiny bit. This peaked at about 116 last night. I was watching. It's actually 117 last night. I was watching it all night long, and that told me the market was going to come in a bit hot. As you see oil rise, everything else seems to be a little bit less concerned. Let's go over to a couple more places since we're here. Go to the crypto market. Bitcoin down to 66.7, but up on the day. And the rest of the crypto market seems to be relatively healthy. Gold should be positive. There you go. So these are classic signs of fear in the markets, pushing people into different types of risk perspectives. We are largely risk off. So you see people see a flee to gold. And because crypto, particularly Bitcoin, has seemed to have volatility that gives people more of a risk kind of uneasiness now, we're seeing a little bit more of crypto being treated more like a traditional equity in some ways when it comes to fear and the hedge against inflation dialogue. So just observational. The calendar this week is an interesting calendar. You got CB consumer confidence coming up. I expect that to be ugly. ISM manufacturing data on Wednesday. The JOLTS, the preferred measure for jobs, or one of the preferred measures for jobs for the FOMC, comes out on Wednesday. I expect that one to be also not so pretty. And then throughout the rest of the week, you got some construction stuff. We're going to cover a little bit of that today. Balance of trade, initial jobless claims, natural gas storage. And then you got non-farm payrolls and unemployment rate on Friday. You will hear about that in the headlines. If that comes in ugly, you can expect that to seal the fate in perpetuity for the FOMC. And you'll see the bets on odds of rate increases coming in the not too distant future if that's the case. And I do expect that to be the case. So I'll take a moment here. What up, Saeed? You in the chat? There you go. 55 on synthetic oil. Yeah, the synthetic volatility. Yikes! It is a weird world out there, brother. And I'm telling you right now, I've recalibrated and calibrated and recalibrated these models to make sure that they're accurate for what we're doing on a trading side of things, and they do appear to be functioning as they should. So that does not surprise me that the numbers are where they are. Let's get into the sector analysis. Whammy. Home builders are actually somewhat meh on the day. This is rate sensitive demand. I think because the rates hit hard last week and you saw them take a bit of a hit last week pretty aggressively, that this is not a meaningful pivot day because there hasn't been anything to really move the needle one way or the other. Now, if we do not have peace talks manifest in a headline that is validated, then this is going to continue to get worse. That's right. Got a big boy coffee today because daddy was tie. Don't judge me or judge me. That's fine too. I have not been sleeping super well, and it's not for bad reasons. It's for good reasons because I got a lot going on over here in the studio. We're building a lot of cool stuff. I'm building a new program too, which is also fun. And we are in the paper trading phase of our AI model that we're building for, to deliver to you guys, this alpha model. And in the paper trading phase, I've noticed some anomalies, right? So if you want to use prediction markets like Kalshi or Polymarket to bet on economic events, not necessarily like sports or crypto pricing, it has longer contracts. So you can't kind of like day trade, if you will. You can't trade with volume on these contracts quite the way that I had hoped and envisioned. But it did create an interesting thing. So one of our models, which I'll use as a proxy kind of for the bigger picture, is a model which tracks the probability of future rate cuts or increases for that matter. And so far, our models have been weeks ahead of where the market's temperament has gone over this time, right? So we knew a couple weeks out that a rate increase was more likely than a rate cut from a probability standpoint based on the macro data that the Fed itself says it's watching. Which is ironic because if the human element is allegedly watching this and the AI element is watching it, and the AI is programmed to use the same logic and back testing data that the Fed is using, pulling from the same data sources, St. Louis Fed, BLS, and so on and so forth, it makes no sense that our model would see this clearly, whereas the humans would not. And at first I was like, okay, well, our model is just fucking broken, right? It's not working. Well, no, the model was working, and 3 weeks afterward, in our case, it was 70% probability. The markets were saying that Kalshi and Polymarket prediction markets were saying about 50% probability of a rate increase. So we were 20 basis points high on that. We would have wagered pretty aggressively, and we have confidence scores built into this. We do daily tracking multiple times a day in real time using the same massive data that you see here pulling in real time. So we've got lots of just information coming in at all times. Well, that contract would have paid great if you would have bet on it when we originally said, but you had to hold it for a prolonged period of time, i.e., the next Fed rate cut. You can't trade them as probabilities change throughout the week, which kind of sucks. But what that does allow us to do is have a very confident money making contract in place while we use something like Alpaca, which is an AI driven trading model, or you use in whatever trading platform you want. Think E-Trade, think Fidelity, anybody, Robinhood. And you can trade on those same like kind of observations and trade intraday. You can trade in the week. You can trade in the month based on some of the things that we're seeing here, like our forecast model, which I haven't shared with you guys in a while, but we'll take a look at that. I think it's valuable to do that. And I think there's a couple things here that are, yeah, SpaceX IPO and some other stuff there. SpaceX IPO is really interesting too. Elon's doing some really fascinating, weird stuff, giving a lot of allocation to individuals too, which is strange. We'll get into that kind of in the back half of the show. Let's spend some time on the sectors here. So DR Horton, we know the home builders. Okay, we've seen some incremental improvement while I was talking. Look at that. There you go. And before I go in, has anybody got any comments or thoughts or suggestions? Saeed, you there? Sean, feel you on the lack of sleep. Yeah, baby daddy in the house. That's right, Sean. Don't think I forgot. Don't think I forgot. He's out here having kids in the delivery room watching the show. I mean, I don't know if that is something that Saeed and I ever expected when doing this, right? Like we do the live show because it really gives us proof of concept, and it's all behind, kind of pull it off YouTube after we do this because I want to share it with you guys. I want it to be public, but for the most part, this is just us, talking to the core audience. And I never thought in a million years somebody would ever tell me they were having a kid and being on the show. You got Saeed Omar in the chat, my co-host, as handsome as he is. We went to a wedding. Saeed, you looked very handsome at the wedding. Very, very handsome. Rosie, can't wait to hear the market tea. Yeah, Jerome Powell's a jackass. We'll get into that. First day back to work after maternity leave, so I have been. Oh wow, I didn't realize you were officially going to go back. All the chats we've had, you've been at home and trying to catch the show midday. I'm glad to see the show hasn't seemingly interrupted your day back at work, but. Hey, maybe I should be selfish and say, yeah, that's right. The show is more important than keeping a steady paycheck. But hey, it is what it is. And I am selecting from the comments. I apologize. There's a lot more there that I haven't got to. What up, Yoshi? What up, Jimmy? How you doing out there? Instagram is hit or miss, man. I don't like the way Instagram does their live data. It's kind of meh. But I'm also a bit of a hater. Let's go to the banks, shall we? All right, banks are all kind of, again, incremental in the day. We're still in a defensive risk-off position, so it doesn't surprise me. I still believe the banks are going to be where the money is going to be good as margins increase over time and the interest rate volatility settles out. But for right now, the whole private credit rhetoric is kind of acting as a bit of a pullback on this. That rhetoric was big this weekend, although I've been kind of trying to get away from some of this negative stuff you get in the social media sphere. It's just so overwhelming. Between war and oil prices and negative. It's just like some days you just want to decompress. So I've been getting away from the data, although I did share some stuff on my X feed, which we're going to go over as well, about construction and the construction industry, which sounds a lot worse than it is, and some other stuff. I have a lot of the show links on the YouTube channel, on LinkedIn as well. If you're watching on either one of those platforms, those are some of the links that we're going to talk about here. CRE, commercial real estate REITs, those are actually up today, which I found a bit surprising, incrementally so. But again, data centers are not going away anytime soon. People are going to switch from office focus like they had historically to data centers. And you're going to see, I think, more growth in this space than probably most of us would have expected just a year or two ago. So keep an eye out for those. And I still believe that real estate investment trusts are going to be a shining star in the next year. If you want to own real estate, that most people are going to go that route. It's really, really hard to buy investment real estate compared to what it once was. Maybe even recently, it was like 5 or 6 years ago. And I say that as a guy who has a lot of investment real estate. So mega cap stocks are indifferent in the day. Apple, Microsoft, Nvidia, Amazon, Alphabet. You guys already know my opinions on Microsoft. It's a dog shit company who hasn't innovated in, 30 years. But I got an interesting take on Apple, which we can cover now, we can cover later. Let's cover it now. So Apple has not really been the front runner of technology. We all know that some of the stuff that you can see from Samsung and other competitors gets out to the market way before Apple. And Apple as it relates to AI, decided they were going to sit on the sidelines. And people were like, "Ah, you guys are fucking up. It's not going to be good. What are you doing, Apple? Steve Jobs wouldn't have done this. No, 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 no." But that may have been wrong, to be honest with you. It sounds like Apple is now nearing pulling in some people in their ecosystem. You think about this from the context of what that means for most people, right? Is that Alpha, and I'm going to try to pull up the chart. It's coming from the Financial Times. Okay, perfect. There it came up. Great. I'm going to go over here. Blah, 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 blah. Let's go to the screen here. All right, so I'm going to go into the social view first. So basically, Apple is an ecosystem which is in the hands of more people than any other mobile phone device in the world. So if you have an AI product, you want Apple to use it. So people are incentivized to get it in Apple's system, so that relationship is symbiotic. It's not one-sided, which means better pricing for Apple. Apple really nailed AI by doing fucking nothing. That's a quote. That's not me, but it sounds like me. 135 billion in the bank, stole Google's model for a measly $1 billion, now forcing competitors to plug their models into Siri if they want access to 2.5 billion Apple users. Patience or laziness paid off massively. It did. Let me show you what I mean by that. Let's go over here. This is a chart from the Financial Times, revenue generated per dollar of fixed assets. You got Meta, you got Alphabet, Amazon. I'm just going to discount Microsoft. And look at Apple. Look at that shiny star right there, crushing it, making money. What up, Regil? On the Instagram chat. I was wondering if you were going to come visit me and play. So yeah, Apple is crushing it as far as revenue goes relative to their peers. And then you throw in things like they just created the Neo, that laptop, which really runs off of a predecessor Apple iPhone chip, and it's going to bring in an entire new generation and demographic of Apple ecosystem fans. I started off as a PC user. I'm on now entirely in the Apple ecosystem. Apple got smart here. I'm waiting for Microsoft to do the same thing, because look at Microsoft. Look at them. That is poor performance. I don't care what anybody says. That sucks. And this is what I mean by they haven't innovated in God knows how long, right? Like that. Like, what do y'all do? If you're Microsoft right now, the only thing keeping you afloat is that every a-hole in the world basically has your product. And I'm gonna pull up Microsoft stock, MSFT. I'm gonna pull it up here. Every a-hole in the world uses your product to type and to use Excel and everything else, but that's changing, man. It's changing big time. Nope, wrong one. And I think AI is going to disrupt that big time. Believe it or not, that's just my sentiment. But let's just look MSFT. Let's look at two different charts here. One we haven't looked at in a while. I'm going to look at the 1 year on Apple. No, not Apple. On Microsoft. Sorry. So there you go. It's Microsoft. That's 1 year. I mean, I guess you could argue that that's, going back into place, but what have they done? I mean, seriously, what have they done? I'm not a big fan. I don't get it. I don't like it. I certainly don't like the last month. And then let's look at the 1 year. So, I mean, this spread isn't that big, right? I mean, you're kind of okay there. Let's look at the 1 day. I bet you it's trading kind of incremental on the day. Come on, load for daddy. There you go. All right. So, yeah, trading near session lows. So, I mean, not exactly what I would call crushing it, huh? Huh. Interesting. I gotta figure out why this keeps happening on the 1 day charts. That didn't always happen, and I'm not really sure what's going on there. But let's take a look and see what our model is saying on the forecast side of things. So I don't really show. Oh, sorry about that. MSFT. So what I'm going to do here. This is our outcome forecast model. I don't share it on every show. There we go. That's your Microsoft. So according to this, wow, market open. All right, so it shows it's up year over year. I'm not really sure how it's calculating that. I'll have to double check it. But trade allowed, it says caution the trade. Shares are, if you're going to buy, short trade only. Don't go long in this stock. And the risk level here is elevated. Macro economic environment's not good. The market's not good. The symbol event and the symbol event and event market are not good. So 53 basically means you can watch it, but don't trade it. Top drivers as of today, the CB Consumer Confidence Score in 19 hours may change the inflection point of the overall market. ISM manufacturing data in one day, and JOLTS job openings in one day. What this is basically telling you is the market performance isn't strong. It doesn't recommend a long-term hold, and there are some things coming up in the near term which are likely to cause some momentum shifts in the overall market. So even if you went in this as a short trade, you have an elevated risk level because there are some statements that are going to come out related to jobs and consumer confidence, which could move the market against you meaningfully. So that's kind of the intent of what the outcome forecast model does. This is a bit of a dumbed down version of what our algorithmic model does. Let's get back into the sectors here. I know. I'm losing some energy here. Rajil, I'm here, brother. Yeah, I see you, man. It's good to see you back. I haven't seen you in the show in a while. Can you get into the disconnect between the market and our economy? Seems like there's a market rally every week. Yeah, that's man. So this is the behavioral economic piece that really bothers me a great deal. And what you're hinting at is a legitimate frustration for me, Rosie. Let me see here. I'll put this up on the screen so I don't look like I'm talking to myself. So this is a real problem. And all I can tell you is there is an element of uncharted territory in where we're at with social media, with the retail trader now democratizing space, i.e., Robinhood and similar situated people. You can build an agentic AI Mac Mini now. You can algorithmically trade the market, even if you're not a market trader and just the math. So there's a lot of disruption. I think having learned firsthand through the contagion period and being an executive at a publicly traded institution that a lot of the talking heads are just completely wrong. They're smart people. They sound smart. They're reading off teleprompters in most cases, but I don't think that they understand the space as much as they do, and they have a tendency to say things which may seem like a simple observation, which can be cataclysmically wrong. And I saw that where I was living through the bank contagion period, and people were talking about things that were completely disconnected to reality. So much so you have to ask yourself if there's motivation there. And I think the easiest motivation to point at is that they trade to their audience. They pander to them, right? And that is a simple trade for them to make. Look, if we give you optimism and we give you perspective that this is going to turn around, the market's not going to take it, the market's resilient, what happens? Well, people want to tune in because you're counterintuitive to the way they feel. And that's the problem with the extremism that we have in the market across several different things. I mean, social media is just one of many great examples on this, right? If someone gives you an optimistic spin and you want that optimism, you're going to go into it hard. On the other hand, there's an entire sycophantic negative kind of feedback loop that happens on places like X more than other platforms. I think X is largely bot driven too, where people feed into this negative diatribe of the market's going to crash, the market's going to crash, the market's going to crash. And I don't know if that's any more true than hey, the market's going to turn around narrative at this point in time. And that's the sick part, is that nobody really knows what happens next. You just know what the probabilities are based on the data. But we live in the world of information and disinformation, in an age where information and disinformation can travel much faster than material facts from credible sources. And even so, AI seems to make a lot of credible sources look like they said it when in fact they didn't. So I think there's just too much money invested on Wall Street and too much to lose for people to try to let the market fail. And the narrative that you come out seems to push the financial and fiscal narrative, which is we can't afford for this to fail. That makes sense. There is an argument that it is manipulated. I don't know that I've got a counter argument to it. I can only tell you that we can only play the game by the rules that are in place, unless you're in the ability to change the rules camp, and very few people are. Yeah. And this is a great example of it. So the market is still standing because of vibes. Yeah. Yeah. Vibes it is. Speaking of which, we had a very interesting guest on the show. Saeed and I try not to get political, but we had Sheriff Bianco on the show. He is one of the two leading candidates Republican candidates for governor of California, and I think he's got a good shot at winning. I did not go into it expecting to like him as much as I did when he left. He was charismatic. He was kind. He had many opportunities to trash Democratic candidates or to take shots across the bow, and he chose not to do that. And he came in, and this is not something you'll see on the camera, but he came in with no like media representative, which is typically what happens. He had security and all the stuff that you would normally expect, but he he came in entirely on his own, and he wasn't prepped for the show in advance. He just came in raw and just had a conversation, and I was very taken aback by how clearly aware he was of some of the alternative agendas in Sacramento as a state. So I think you get guys like him who can make policy, and maybe some of these non-politicians. This was very successful in Nevada not too long ago. They elected a sheriff there, and that sheriff changed the party entirely, but is also a safety first driven leadership model, which California could probably use. Given the homeless population, the crime rate, it's an interesting way of looking at it. I don't. Again, we're not a political show, but I just thought that having these conversations with some elected leaders, because the platform allows us to do so, would be wise. So if there's anybody you guys like to see on the show, let Said or I know. We can do that, and I think we will as time goes by. Let's finish off the sectors and get into some of the more fancy stuff, shall we? So we know that the market leadership is, leading the way into essentially nothing. I'm a big fan of the consumer staples, the Walmart, Target, Costco, Home Depot, Dollar General. Target down a little bit today. I still believe in Target, their turnaround story, but I believe that they're going to do well. The industrial space, real economy signals is all really down. Caterpillar and General Electric in particular. Energy is going to be up. There you go. And that's going to continue to happen as oil prices rise. This is what happens. Geopolitical conflict is that there's always going to be some winners, some losers. Exxon, Chevron, Conoco, Schlumberger, or Schlumberger, if you like that. They're going to do well. In defensives, this is the one that our model has proven time and time again. These are where the money goes when we're in a capital fleeting position. So if I go back to the status of the market, we're hiding in safety. We're in a defensive position. We're not full risk off liquidity. But where does money go when it's hiding in safety? Where does money go when it wants capital preservation? It goes into stocks like these. Procter & Gamble, Coca-Cola, Johnson & Johnson, Xterra Energy, Duke Energy. These have been solid winners. If you would have taken that advice once you saw the model get to this point down, and you said, hey, Chris says the money's going to go there, you would have made some money incrementally in the last week or two. Not because I'm a genius, but because that's just the cadence of what we've seen historically through turmoil. Is there are certain capital preservation stocks that people go into when controversy and volatility hit the market? Okay, that's what it is. XAI, baby! It's March 30th. Let's talk about the insights and some of the information that we're seeing in the market today. First one, CTA, systematic selling exhaustion. This one caught me by surprise. Commodity trading advisors have sold $85 billion in U.S. equities over 30 trading sessions, making the largest such sale period. This systematic selling pressure may be running out of steam. What does that mean? Well, you don't take my word for it. Let's talk about AI. CTA selling exhaustion often marks major market bottoms, suggesting potential reversal opportunities as algorithmic pressure subsides. Now, I don't know that we're seeing the bottom. I know that's the narrative that AI is putting forward. I hope that that's the case. I don't think you see a bottom until such time as you see, as you see a solution for peace talks. If we go boots on the ground, for example, in a war, which I think is a high probability, then that is not going to be the bottom. I can guarantee you that. Let's go to the number 2 topic, energy sector historic rally. Again, this is a response to geopolitical unrest. It's not something that should come off surprising to anybody. U.S. energy sector index has gained 14 for consecutive weeks, the longest streak on record, rallying 43%, driven by Iran tensions and rotation out of AI stocks, right? AI heavy stock goes back into where they think they can make the money. The nearest term money is going to come from the economic benefit to energy sector companies. Love it or hate it, geopolitical conflict has caused that. Historic energy rally may be overextended. Geopolitical premium could unwind quickly if Iran tensions are ease unexpectedly. I think that's true. That's not wrong, but it's a strange thing, right? So here's something I could very much see happening, and I think we got to be intellectually honest, right? The White House could say we've reached an agreement, and then you'll see some press come out saying from the Middle East, no, we haven't. And how do you know? How do you know? You don't know. And then there's going to be this natural tension in the headlines. You don't know what you don't know, but the market will trade and rally off just the presidential headline alone. We reached whatever treaty, or we've gotten peace, or we're going to be in a healthy position. You can expect the market to rally back as a result of that, and then everything will be flooding back into the market. Our market status will change. The overall perspective of the numbers that we're looking at will change, and we'll see a swing back the other way. And then the narrative is going to switch back to a focus on unemployment, focus on private credit, and a focus on the overall health of the financial system and rate cuts versus rate increases based on the data that we're seeing. The data that we're seeing is not driven, as it relates to rate cuts, is not driven by the geopolitical conflict. It certainly doesn't help it, but this was already a driving factor in our models prior to this. Unemployment numbers have been wrong for a prolonged period of time. 1 million jobs last year evaporated. There's great zero hedge articles in this. The way we collect data and the prolonged lag has not improved during government shutdowns. We're in probably the worst one I think I can ever say that I remember right now. And TSA is suffering for it. My heart's thoughts and prayers go out to the families of people who are waiting for paychecks and not getting them, but they're still working. That's crazy. It's an interesting time, and I don't know that the geopolitical conflict in and of itself going away is going to solve any of these problems. I think there will be some market sentiment. And Rosie, to your point, you're going to see optimism swing back in the market. There's going to be this, yay, go, 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 and then it's going to go back to the next cautious headline, because as much as the market wants to be positive and give you hope, they also want to give you fear so they can sell you hope. If you don't have fear, then the hope becomes very mundane and boring. So expect that to be a reality whenever that time should come about. Of course, the number 3 headline topic will come as no surprise to anybody. U.S.-Iran diplomatic tensions. White House signals Trump administration seeking deal with Iran before April 6th deadline, with warnings of consequences, including potential ground operations if no agreement is reached. April 6th deadline creates a binary outcome scenario. I don't know that I would have done this, but it's true. Energy and defense sector is highly sensitive to any diplomatic breakthrough or escalation. So mark it down, April 6th, effectively a week from now. You'll have some type of market response, whether you like it or not. Now, you can bet on that. I wouldn't, but you can. S&P 500 technical breakdown. Technical breakdown below 200 a day moving average historically resolves within 2 to 3 weeks. Current streak approaching exhaustion levels that often mark reversals. This, of course, because the S&P is tracking for the 8th consecutive close below 200-day moving average, longest streak since April, May of 2025. I love it when people say stuff, and even my own AI is doing it. The longest streak since. Okay, it's been a year. All right? Stock market's been around for a long time. All right? So these big swinging statements, it's the worst ever, worst in history. We're going to see some of that in construction. They're not so bad. They sound bad, but they're not so bad. At least not yet anyway. We're still coming off of all-time highs in the Dow and the S&P and everything else. So Fed inflation outlook stability. Fed's mirroring the most aggressive for rate cuts put in place by current president. Sees no evidence of inflation shock from oil prices, with inflation expectations not yet affected. Powell maintains inflation outlook could remain in check. He said that today in Harvard. I find that so disingenuous, but whatever. Fed's confidence on inflation despite oil surge suggests potential dovish pivot if energy prices stabilize, benefiting growth sectors. They're hoping for it. 100% they are. And so we got some other topics we're not going to cover in detail. Dollar surge, strength, surprise. The dollar is resilient. SpaceX IPO restructuring is happening. It's kind of wild, but it's a broader shift away from a retail-focused brokers, and I think he said he was going to pick, E-Trade, which is strange. Ackman quality stock opportunity. This is interesting. Bill Ackman states that it's one of the best times in a long time to buy quality stocks, suggesting value opportunity and market weakness. Maybe he's right. I don't know. He makes a lot more money than I do. I don't know. Let's get into the X side of things. Let's get into some of these links. Let's talk about it, because I think that's where the value is going to be. That's where I think some of this really makes a key difference here. Let's get into it. Actually, let me close this here. I had AI text me these links. So, one war, 7 global shortages. Saeed was the first person to put me onto this, and I hate complimenting Saeed, but he did. Here it is. This is a global depression in the making, according to some people. It's not an that's not an understatement. One war, seven global shortages sounds like crazy, but we've been having so many conversations about oil going through the strait and what that means for everybody. We haven't really focused on something like this, and this is a real problem. Okay, from this region alone, you get 50% of the world's supply of urea. You get 45% of the world's sulfur. 30% of the world's ammonia, 30% of the world's helium, which is what Saeed and I talked about on the show, and 20% of phosphate, LNG, and crude oil. The part that's shocking here is that crude oil that we talk about in the headlines, which is such a backstop to so many things, is only one of the smaller portions of these seven. Helium, for example, is used in chips in the semiconductor space and in producing the technology, the hardware that we deploy for AI. So AI is, unless there's some type of backstop of this somewhere, surplus hiding in plain sight, this could be problematic for the creation and distribution of chips, which nobody's talking about. Of course, ammonia, sulfur, and urea are also used in farming and all sorts of other products. So expect there to be trickle-down effects as this goes on for a prolonged period of time, because the massive amount of supply of some of these products that come from these regions are going to have to be brought in from somewhere else, or the shortage is going to drive costs up, which eventually get passed on to you, me, the consumer, and everybody else. So for Jerome Powell and Mirren to be like, well, we haven't seen the inflation effects in the data. Okay, bro, fuck off, right? Like, I'm nobody. I'm sitting in a studio with an AI Mac Mini next to me, pulling in the data you're supposed to be looking at. And if I can see the inflation effects, and I can see how wage inflation is not kept up with the cost of living inflation, real inflation, CPI, you can exclude, you can exclude food and energy, but why would you do that? We all pay energy bills. We all pay for food. Yeah, they're more volatile. Well, guess what? Things like this, where ammonia, sulfur, and urea are used in part for food production, are going to drive food costs up. It's not insane to think that you got a fundamental fucking disconnect here in the things that people are saying versus the things that we're actually seeing. And, I don't mean to patronize people, but that's a real problem. And it's a problem that, frankly, our government and our elected leaders and the people that we put in place are not really focusing on. And I'll show you a great example of the strain that's real and material that nobody wants to talk about. Here we go. Nearly 1 in 3 car buyers are underwater on trade-ins. 1/3. Okay, analyst calls dollar amount troubling. Okay, that's a problem. If 1 in 3 across this country, now I understand that being underwater is not that uncommon in a vehicle when you've got longer financing terms, you're bringing in extra debt into it, but this is a problem. Okay, not 1 in 3 people in the country have subprime financing. The average amount owed on a trade-in with negative equity, again, negative equity, nuts, reached $7,214 in the fourth quarter of 2025, an all-time high, according to Edmunds. The average price of a new car is $49,353, which is 30.3% higher than in February of 2020. Okay, I'm going to drive that fucking point home real clear, okay? Just to make sure we're on the same page, right? So, 2020. I probably should do that right. Let's do that again. 2020. Okay. You are now 30.3% higher for the average price of a new car. 30.3%. Did any of us in the last 6 years get a 30% salary increase unless we got a different job or a massive promotion? No. This is the fundamental problem. This is why I keep saying wage inflation is not kept up with the cost of living inflation. And this is only one element. I think the average inflationary impact of most of us is 20-25% when you take the, because look, we don't buy a basket of goods, how inflation is calculated. We go out and buy food, man. Eggs are more expensive. We're going to buy eggs, which means we have less money. That's just how this works, right? Among the new car purchases involving negative equity, 40.7% are now financed with 84-month loans. 40.7% of car financing is on 7-year terms. 7 years to pay it off. Because people can't afford the monthly payment, so they're stretching the payments out over a prolonged period of time, creating a negative equity loop, which is a fucking problem, okay? It's just a problem. And the fact that we're just seeing this data and we're not like stunned by it is wild. Okay, it's just completely nuts. And I know that I'm cussing a little bit more today. I'm a little sassy and salty, but you know what I mean. It's been a lot of this data lately. It sucks. So you can see where the frustration is coming from when you see people like Jerome Powell going to Harvard saying, well, things are okay. Things aren't that bad. It could go either way. Really, what direction does this go, my guy? Do people get like massive salary increases? Because if that's going to happen, that's in the future, then I'm all for it. Great. Good for all of us. Good for America. Good for the people. But I don't see that happening. And I'm not trying to be a sadist or negative. I'm just trying to tell you that there's problems here. And you might say, okay, well, Chris, that's autos. Okay. Housing doesn't have a problem. Yes, it does. There are way more sellers in the market than there are buyers now. Over 600,000 more, which is an uncharacteristic and unusual set of circumstances. And I'm sure the housing pundits will push one way or the other. But Daddy came with data today. This from Lance Lambert. Gray, how much the largest lobbyists spent in a given year. In blue, how much the National Association of Realtors spent lobbying in a year, okay? NAR, the National Association of Realtors, was America's largest spender on federal lobbying in 2020, 2022, and 2024. And this is why I talk all the shit on the National Association of Realtors. I'm a real estate agent, okay? I'm a realtor. I'm a real estate broker. I've been one since I was 18 years. For almost 30 years. God, I'm getting old. Shit. For almost 30 years, I've been in this business. I love it. But I will tell you, if you think for a fucking second that the National Association of Realtors isn't like a complete Gestapo, like militant regime that is unfairly taking advantage of the American consumer, you are lying to yourself, okay? There is no world where this business should not have gotten more innovated over time, right? They're trying to protect their base because they are a lobbying group. They have a political and financially vested reason to ensure things. And to give you an idea here, I'm going to say this again. The National Association of Realtors in the blue versus the largest lobbying groups in the country, right? People who lobby for things like, I don't know, every political party you name. This is the largest in the country, right? They were the largest spender in a number of these years, right? So there you go, 2020, 2022, and 2024. They spent more than anyone trying to prevent their space from being democratized. And they have that level of political power. You're lying to yourself if you don't think that these people are in with politicians trying to make sure that the guaranteed commissions stay there. And that's also why I talk a lot of trash on Lawrence Yun from the National Association of Realtors being the chief economist. Lawrence, your data is unpredictable, brother. I hate that we show up in Google as like similar situated people when people search our names. You want to know why? This is why. This is an unfair political bias that you are leveraging, spending a ton of money to try to lobby for things that benefit your group. I understand that we all do it, okay? But this space is ripe for disruption. And every single time that comes along to try to foster and build the credibility and names of real estate professionals, like myself in some cases, right? This group steps in and prevents that, and it gets worse and worse over time. It's not a good thing. All right. I don't know how else to say it. It's not a good thing. It's very problematic. And it's one of those things that, frankly, will come to a very ugly head at some point in time when somebody gets frustrated and there's not enough dollars to save it. Okay. Let's go on this one last. Oh, no, sorry. That's not it. I had one on the builders that I wanted to go over. Let's see if it made the notes. But, let's see. 1 second. Do I have the builder one? I don't have it here, but Daddy always comes prepared with backups. Give me 1 second. There's one I wanted to share with you guys. Where are you? Oh, maybe I didn't send it in. Oh, you know what? I posted that one. I didn't send it in, but I posted it to my social media. See? Every once in a while, I do think ahead. All right. So, shout out to the people on the X watching live. So here we go. Here's a breakdown from this morning. This came out last week. I didn't have a chance to look at it till this morning. So U.S. construction spending just posted its worst month since 2009. Now this is a meaningful bad piece of data, right? So if it's been the worst in a year, I'm like, meh. It's not that the year's been an incredible positive run. This is the worst in what 17 years? That's meaningful. February, negative 8.8% month over month, but negative 2.9% year over year on construction spending. If people are saying we have a housing supply shortage, well, there ain't going to be a whole lot of supply coming in here. Here's the breakdown. Residential, 4.1% negative year over year. Commercial, negative 6.8 year over year. Infrastructure, plus 2.1% year over year is the only green category in construction. When mortgage rates hit 6.88% last week, their highest in 6 months, this is the real economy responding, not sentiment surveys, not consumer confidence, actual cranes stopping, actual projects getting shelved. That's meaningful. Let's go over to the Instagrams. And for those of you following, I'm going to share. I saw it on Yahoo Finance earlier. I want to see if it's still there. Grant Cardone. Fannie and Freddie announced revisions to condo insurance standards, as they should. I want to go over to Yahoo Finance. There we are. I saw this earlier. Let me see if I can... Where is it? Powell's advice to Harvard students. There we are. Let's see here. Give me 1 second. And I want to refresh this so we all play on the same page. Here we go.
People who run those companies, and they're all looking at what they can do, and the truth is they can take out a lot of jobs that can be automated by a very smart large language model. They just can, and they will. These large language models make people much more productive. I feel like it's making me more productive because I can learn things really quickly. And I talk to my son and others who are out there in the world, and I think if you use it well, it's making you more productive. So I think you're in a situation where you need to invest the time to really master the use of these new technologies, and that should stand you in good stead. Major U.S. companies.
Talking to your son about technology, and I don't know what his son does. I'm not here to judge. But you are not... Okay. Fuck. Look. Does an LLM, if used appropriately, make you more productive? Yeah. Yeah, it does. Sure. Yeah. Is that where we're at today? No. We are in agentic AI. There's a flow here, right? LLM, agentic AI, clusters of agentic AI working together, if you want to call it that. AGI, baby. AGI. Artificial General Intelligence. There's one more step. Then you get to super intelligence. Artificial General Intelligence, smart as a human. Super intelligence, smarter than us. I know some people argue how close we are to AGI or not. I don't care. Agentic AI, as of right now, not tomorrow, not 6 months from now. Now, right? AGI is not only making you more efficient, it's doing the work for you. Okay, that's the elephant in the room. That's the problem. All right. If I can go buy a Mac Mini, or use a VPS in a cloud-based version of this, or frankly, Cloud Code with plugins now. I mean, you has a remote function on your phone, right? You can just plug Cloud Code in there and go nuts on it, like the sound effect. And if I can do that, okay, and then that $200 a month subscription, if you're on the Pro plan of Claude, for example, or that $800 investment into a Mac Mini, plus taxes and API fees and all that stuff. If that can do, let's just throw out a number, 50% of my work to increase my output. Am I going to tell you, my employer, that I'm way more efficient and you guys should give me more work? No, I'm not going to do that. You know what I'm going to do? I'm going to keep using it. Except here's the problem: is I am training that model to do my job, and at some point it probably will, because the employer is going to go, I could pay Chris his salary of X, or I can go buy a Mac Mini or use a VPS cloud-based service and just pay a couple $100 a month. And then that's the end of Chris working the job. You'll tell me, hey, you do twice as much of the hard work that AI can't do, or you don't have a job. And that's where this is going. It's going to make us work harder and have the more complexity. And a great example of this is what Meta did recently. Meta has said that if you manage 10 to 12 people, that in the age of AI, you should be planning to manage, 50, 60 people. And guess what? You're not going to do the easy stuff. You're going to do the hard stuff that AI can't do. The human element portion of it that requires you to actually physically work. And AI won't be able to do it because that's why you're doing it and not the AI. Otherwise, they would replace you entirely. So you can see how this goes down a path of a lot of change. Now, I'm not saying to be afraid of it. I'm saying to get ingratiated, get in there, get deep. But yeah, I don't want to interrupt as I'm interested in the housing market. But out of curiosity, what does $150 a barrel in Asian market really mean for the rest of us? It means increased prices. Well, I think so let's back this up a little bit. Let's go to the comments here. I'll share. Yeah, all good. White hat. You never interrupting, brother. I tend to go off on these tangents, and I'm kind of that way. So look, 80% of the oil that goes through the Strait of Hormuz is for the Asian markets, most notably China and some of the other counterparts in that region. So their markets are and should be more impacted than the United States. However, with the tariffs now off, and countries like Russia, which never really respected the Western sanctions anyway, I think that it's going to impact them a whole hell of a lot more than it's going to impact us. But it is going to change the paradigm for the United States eventually, because there will be an oil shock. We are releasing surplus into the market. We are then going to have to figure out how we handle our reserves. So yes, you can expect there to be a trickle-down effect to oil costing more money everywhere, not just there, because the demand is higher. This is a supply-demand argument. This is a classic supply-demand argument, right? Like if the demand is still there and the supply is shrunken, it's just going to go up all over the world. Asian markets, because they've had more supply constraint as a result of this, are naturally seeing the impacts higher. But our oil isn't too far behind, frankly. I don't know if you're referring to Brent or crude, but I think it's Brent, probably crude. No, Brent, sorry. Probably Brent you're referring to. But yeah, we're not far off. We hit 117 yesterday in futures market trading. We're down a little bit today from that. But if we don't see meaningful resolution or progress by April 6th, I would expect there to see some increase to our markets here. And if you see that, there's a number of smarter people than me from an economics perspective that have suggested that anything at a prolonged period of time over $120 a barrel in the United States would effectively force a recessionary like economy. So I think that that's why you've seen that kind of like the litmus test of where we've been, balancing. I think that's also why the oil futures market hitting around 117 overnight was such a kind of a headline. Thankfully, it settled back down. The treasuries are back down today. But again, volatility. Like we said, when this whole thing started off, just expect things to be more volatile for a longer period of time. That's where we're at. And I haven't really responded to the comments. So yeah, Rosie, 7-year car notes. That's nuts, but it is true. And I'm not sure if it's a good thing. I would be lying if I didn't say that when I bought the Rivian, for example, I wasn't tempted to do that. I think I went for a 5-year note when I first got it, and because it's good to have the auto debt and then pay it off. So I always get debt on new cars and then pay it off a little quicker. But I think I went with a 5-year, and I was paying like $1,100 a month after my pretty sizable down payment. So it's tempting because people are cash flow constrained. The problem is at what point in time does all this come to a head? At some point, we got to trade in our cars or sell our cars. Most people don't keep them all the way to the end. So that could be a trigger point. You've got credit cards that are getting close to pretty high numbers, private credit. There's lots of weaknesses in the economy. But again, until something meaningful happens, and I would have thought a geopolitical unrest from a war would have been it, you're not going to see this optimism in the markets and the headlines die down. It's weird. Yeah, of course, man, anytime. Got your back. Well, that is an hour-long show. Unless anybody has any comments, thoughts, suggestions, this is typically where we call it a day. Hopefully, we gave you everything that you can get from CNBC in one short day. I wasn't going to go over more of Jerome Powell's comments, but you get the gist. And part of it could have been he was just pitching to an optimistic group of people, but we'll see. So until next time, everybody, I sincerely appreciate you. Said and I, frankly, we do it for you because we love you. Until next time, everybody. Okay, bye.